Welcome back, everybody, to another deep dive. And today we're tackling a big one. Can you really build a $1 million retirement portfolio with just 3 ETFs?
Ambitious. Right.
Very, but that's what the Motley Fool seems to think. We've got their article right here laying out what they say is a simple plan to do just that. So
Definitely worth a deep dive.
yeah, let's break it down, see if they're onto something here. Now, their first pick is the Vanguard Dividend Appreciation ETF, ticker symbol VIG.
Okay, VIG.
I know when some people hear dividends, they think that's just for income, but this ETF, this is a little bit different. So what's the strategy with this one?
Yeah, so with VIG, it's not just about companies that pay dividends. It's companies with a history of raising their dividends consistently.
Okay.
And that's really important.
So it's like a sign of strength. They're doing well if they can keep upping the dividend, right?
Exactly. It shows they're financially healthy, their profits are growing. It shows they're pretty confident about their future. It's a good signal, underlying quality.
Oh, that makes sense. So it's not just about the income you get today. It's more like you're betting on companies that are just going to keep on growing. And that means, hopefully, your portfolio grows right along with them.
Exactly. And the Motley Fool, they actually cite some pretty impressive numbers here.
Oh, yeah. Let's hear it.
All right, so from 1973 to 2023, get this, dividend-growing companies in the S&P 500, they averaged 10% annualized gains.
10%!
Wow.
That's double the return compared to companies that didn't raise their dividends.
Okay, that is a big difference. So, obviously past performance isn't a guarantee, but still, it's interesting to see.
Shows you the power of that approach historically.
Yeah, definitely. Okay, so we got VIG. That's about finding those steady companies. But what if you want something a little more, exciting, a little more dynamic? The Motley Fool, they also like the iShares Core S&P Mid-Cap ETF. That's IJH.
All right, mid-caps.
Now, everyone's heard of the S&P 500.
Yeah.
But why mid-caps? What's the appeal there? Well, you see, mid-cap companies, these are the ones with market caps between $2 billion and $10 billion. That's sweet spot. And they're often seen as, kind of the sweet spot for growth.
Oh, okay.
How so? Think about it. They're past that really risky startup phase.
Yeah.
But they're not these giant lumbering corporations yet either.
So they got room to grow. They're not maxed out yet.
Yeah, there's a lot of potential there.
Interesting.
And, historically, they've done pretty well. Since 2000, the S&P 400, that's what IJH tracks, it's outperformed the S&P 500 by almost 2 to 1.
Wait, 2 to 1? That's amazing.
It's a pretty compelling argument for at least taking a closer look at mid-caps, I'd say.
Yeah, those are some big numbers.
Right.
Hard to ignore that. Okay, so we got our steady Eddie with VIG, we got our maybe up and comer with IJH, but there's one more ETF on the Motley Fool's list, and this one feels a little bit different. It's the Invesco QQQ Trust. QQQ tracks the Nasdaq 100, and this one is tech heavy.
Oh yeah, very tech heavy.
So that brings up the question of risk, right? Because is it really smart to put so much into one sector, especially one that can be as volatile as tech?
Right.
We've all seen what can happen, right? Bubbles burst. Look at the .com crash. So is QQQ just too risky for a retirement portfolio?
It's a valid concern, no doubt. Tech can be volatile. But, on the other hand, there's also this really compelling argument for having at least some tech in your long-term portfolio.
Yeah, how do you ignore it? Right.
Right. Technology is driving so much innovation, so much growth across the whole economy.
Yeah.
If you completely ignore tech, you're potentially missing out on some really powerful returns.
Yeah, it's like you're betting on the future, I guess.
Kind of, yeah. But obviously, got to balance that potential with, the risk. Like you said, tech can be unpredictable.
Exactly. So how do you do that? How do you balance that growth potential with the fact that QQQ is, it's pretty heavily focused on tech?
That's where diversification comes in. And, that's a really important point about this Motley Fool article.
Right.
They're not saying put all your money into QQQ or any single ETF for that matter.
Okay, good.
It's about building a balanced portfolio. You think of these ETFs as building blocks, not the entire structure.
Gotcha. So even if I'm really excited about tech, I shouldn't just go all in on QQQ.
Exactly. You want to consider other investments too. Bonds, real estate, things like that. Spread your risk around, build a more resilient portfolio.
Makes sense.
And this is where it gets even more interesting, actually.
Oh, how so?
QQQ, it actually excludes financial stocks.
Really?
Which is kind of interesting because financials, they tend to have lower returns.
Okay.
And they're more susceptible to economic cycles. They go up and down with the economy.
Okay. So QQQ is like an even more focused bet on tech by cutting out the financials.
That's right. It's strategic. They're really banking on the long-term potential of that tech sector. But of course, no investment is completely risk-free.
Of course not. No, that's a good point. Okay, so we've got our three building blocks, right? We've got our VIG for the dividend growth. We've got IJH for like that mid-cap potential. And then QQQ for the, I guess you could say, the more aggressive, more tech-focused exposure. But I want to zoom out for a second because this article, it really focuses on the potential upside.
Right.
But what about the risks? I mean, things change. The world changes fast. Could like some big event or maybe just like a big shift in the whole tech landscape derail this whole strategy?
Absolutely. I think it's so important to be critical about any investment advice you get.
Yeah.
Even from sources like the Motley Fool. These ETFs, they might have a good track record, but there's no guarantee that'll continue.
Yeah, past performance and all that, right?
Exactly. I mean, what if some totally new technology comes along and smartphones are obsolete? Or what if, like, the government starts cracking down on big tech in a way that hurts the NASDAQ? It feels like there are so many unknowns when you're thinking long term. You're right. It's impossible to predict the future, and that's why diversification is so important. Even if you're thinking buy and hold long term, you got to spread that risk around different asset classes, different sectors, even different parts of the world.
Yeah, it's like that old saying, right? Don't put all your eggs in one basket. But let's go back to these specific ETFs for a minute. Besides, the historical returns and all that, what else stands out to you about them? Anything particularly noteworthy?
It's interesting, I think, how these ETFs reflect different approaches to capturing growth. Yeah. With VEG, it's all about quality and stability. We're looking for those companies with a track record of taking care of their shareholders.
Like the slow and steady wins the race kind of approach.
Yeah, kind of like the tortoise, Might not be the flashiest, but they tend to get there in the end.
Right. Yeah. Then you've got IJH. They're tapping into that dynamism, that potential of the mid-caps. These are the companies that are disrupting industries. They're innovating. So there's the possibility for big returns. But maybe a little more volatility, too.
So they're more like the hare. Fast, agile, maybe a little more risk-taking.
Yeah, I like that analogy. And then, of course, you've got QQQ. And that's really like a laser focus on the future of technology, riding that wave of innovation.
Yeah.
It's about capturing the growth of the companies that are shaping, the world.
But also maybe the most potential for like big swings up and down, right?
Right.
Because tech can be so unpredictable.
That's right. I'd say QQQ is probably going to be the most volatile of the three. I mean, the tech sector, it changes so quickly. There's a lot of competition, so it's higher risk, but potentially higher reward, too.
Okay. So we got the tortoise, we got the hare, and what's the animal for QQQ? Cheetah. Falcon. Something that moves fast and takes risks.
Ooh, how about a rocket ship?
Rocket ship, yeah. Incredible speed, can reach amazing heights, but also prone to, the occasional explosive mishap.
Yeah, I like that. That's a good one. Okay, so we've got our animal analogies. What does all this mean for, our listeners who are actually trying to build that $1 million retirement portfolio?
Well, I think the big takeaway here is that there's no one right way to invest. These ETFs, they offer different ways to be a part of the market. But you got to understand their strengths, their weaknesses, how they fit into your own personal situation.
You got to find the right mix of tortoise, hare, and rocket ship for your own journey.
Exactly. But even with the perfect mix, there's always going to be uncertainty, especially when you're talking about decades into the future.
Yeah, for sure. So it sounds like even if these ETFs sound good, the bottom line is don't put all your eggs in one basket.
Exactly. You've got to diversify. But more than that, I think you really need to be informed. And if you're not sure, get some advice. Talk to a financial advisor.
That's always good advice. So we started this deep dive asking, can you really build a $1 million portfolio with just 3 ETFs? What do you think? Possible.
It's definitely possible. But it's not just about picking the right ETFs. It's about having a good strategy. It's about managing your risk. It's about sticking with it for the long haul. And realizing that investing, it's not about getting rich quick. It's a journey.
It's a marathon, not a sprint.
Exactly.
Well said. And this article from the Motley Fool, it gives us some interesting ideas to think about. But as always, folks, do your own research. Consider talking to a professional before making any big decisions.
Absolutely. A good financial advisor, they can help you create a plan that's tailored for you.
Yeah.
help you navigate all the complexities of investing, make sure you're making the most of your money.
All right, so we've covered a lot of ground today. Any final thoughts you want to leave our listeners with?
Yeah, I think it's important to remember that investing, it's not just about picking stocks or ETFs. It's about reaching your goals, whether that's a comfortable retirement, financial freedom,
Yeah.
whatever it is that's important to you.
Yeah. And those can be big goals. They can feel kind of overwhelming sometimes.
Right. But that's why it's so important to have a good plan. Figure out what matters most to you and then create a strategy to get there.
It's like having a coach in the gym, right? They help you make a plan, they show you the right way to do things, they keep you motivated. A financial advisor can do the same thing for your money.
Uh-huh. That's a great analogy. And speaking of goals, we started this whole deep dive asking if you could build a $1 million retirement portfolio with just 3 ETFs. We talked about VIG, we talked about IJH, we talked about QQQ. They all have their pros and cons. But you've also made it really clear that it's not just about picking the right investments. It's about having a solid plan and getting some good advice. So what are some key takeaways you'd want our listeners to walk away with?
As we've been talking, it's really struck me that this whole conversation, it goes beyond just these 3 ETFs. It's really about a mindset. It's about being proactive, taking control of your financial future, and making smart choices. And I think that all starts with education. The more you know about investing, the better decisions you're going to make.
I completely agree. And it's an ongoing process. Things change all the time in the financial world. So you got to stay informed, you got to adapt, and be willing to adjust your strategy as you go.
Yeah, very true. So to wrap things up, I want to leave our listeners with something to think about. The article we talked about, it highlighted the potential of these ETFs. But let's zoom out even further. Let's say we look ahead 10 years. What kind of global events or maybe changes in technology could affect how these ETFs perform?
That's such a good question.
Yeah.
How might things like AI or the demand for renewable energy or even, geopolitical stuff going on in the world, how might those things impact these companies? It's a lot to consider.
Yeah, it is. And it reminds us that investing isn't just a one-time thing. You got to stay informed, you got to adapt, and be willing to rethink things. So while we've spent some time today looking at these ETFs, I hope everyone's walking away with a better understanding of, how investing works, the importance of diversification, and just the power of thinking long-term.
Absolutely. Stay curious, do your research, and don't be afraid to ask for help if you need it. That's how you navigate the investing world and reach your goals.
Well said. Thanks for joining us on the deep dive. It's like having a coach, right? At the gym. They help you put together a workout plan and they teach you how to do it right and keep you motivated. A financial advisor's kind of like that, but for your money.
Yeah, it's a great way to put it. And, speaking of goals, we started out asking if you could actually build a $1 million retirement portfolio with just 3 ETFs.
Yeah.
And we've looked at VIG and IJH and QQQ. Each one's got its own, pluses and minuses. But you've really emphasized that it's not just about picking those investments. It's about the whole plan, right? And getting good advice. So what are some key things you hope people listening are taking away from this?
It's funny, as we've been talking, it really hit me that this is about more than just those 3 ETFs. It's like a mindset shift. It's about taking control, being proactive with your finances, and making smart decisions. And I think that starts with learning. The more you understand about investing, the better choices you're going to make.
Oh, absolutely. And it's never over. The financial world, it's always changing. So you got to stay on top of things, be ready to adapt, and, don't be afraid to change your strategy if you need to.
Yeah, very true. So as we wrap up, I want to leave our listeners with something to think about. The article we've been discussing, it was really focused on the potential of those ETFs, right? But let's zoom out even more. What if we look 10 years down the road? What kind of things, like globally or maybe big changes in technology, could really impact how those ETFs do?
That's a great question to be thinking about. For example, how might things like AI or the increasing demand for renewable energy or even, geopolitical events around the world, how might those things impact the companies in these ETFs?
Yeah, it's a lot to think about. And it's a good reminder that investing isn't just a, set it and forget it kind of thing. You got to stay informed, you got to adapt, and you got to be willing to rethink things. So we spent a lot of time today on those 3 specific ETFs, but hopefully everyone's coming away with a better understanding of, the basics of investing, diversification, why it's important, and really the power of thinking long term.
Absolutely. I think that's key. Stay curious, do your research, and, don't hesitate to reach out for help if you need it. Those are the keys to navigating the investment world and reaching your financial goals.
Couldn't have said it better myself. Thanks for joining us on the deep dive.